Hi, this is a video that will help you understand the key concepts related to auditor's opinion and audit report. After watching this video, you are going to be able to attempt any questions from the ACCA AA or AAA exam. Just a bit of a heads up that this content is not relevant for the UK variant of the AAA syllabus. What you see on the screen is what an unmodified auditor's report looks like. This is the report that we are going to be building up to. So we will start off by understanding how the auditor's opinion is given, and later on we are going to add to this as we add additional paragraphs or modify the audit opinion. So I'm going to keep showing you this time and again so that you understand exactly what we're building up to. We will be looking at the contents of this report in detail towards the end of the video. This is what your auditor's report is going to look like when it is modified. So when the opinion is modified, this will be reflected in the heading of opinion and basis for opinion paragraph. We'll talk about where an MURGC is added, EOMP, OMP, etc. So this is just an overview of what we will be covering throughout this video. We will keep coming back to this, so we don't need to worry about this at the moment. We're at the completion stage of audit. Just quickly recapping the audit work that has been done up till now. At the planning stage, we would have evaluated audit risk. We would have set our preliminary materiality, which should have been reviewed throughout the audit. At internal control testing stage, we would have tested the system for deficiencies in the design, and for the controls that we did choose to rely on, we would have tested them for operating effectiveness. We then moved on to substantive procedures, as we call it. That is just a fancy way of saying that double entries and disclosures in the financial statements were confirmed. So in AA language, we were working on the assertions that were made by the client in the financial statements. Then at the review stage, we would have completed the going concern review, the subsequent event review, and the overall review. And we are now about to give our audit opinion. So at the end of this entire, say, month and a half process, we have come up with two types of issues that we need to now deal with. I know misstatement is a word that you would have studied earlier, but let's talk about the meaning that it actually carries. So a misstatement is the difference between the amount or the disclosure that has been recorded by the client in the financial statements and what should have been recorded as per the financial reporting framework. So for example, the client has recorded revenue of 5.6 million. Based on the audit work that has been completed, I can conclude that the performance obligation for 0.6 million has not been fulfilled. This should have been booked as a liability or deferred revenue instead, and therefore revenue is overstated and liabilities are understated by 0.6 million. So that's the first misstatement that has been identified. This is a factual misstatement. I can see that there has been a clear breach of an accounting standard. In another example, we have inventory. The client has recorded this at 1.2 million. Based on my procedures and based on IS2, where you have to record it at the lower of cost and net realizable value, my conclusion is that it should be 1 million instead. And therefore, because this is an identified misstatement, the difference between the two is 0.2 million, and this is the amount by which my inventory or the client's inventory and profit are overstated. The third one is an interesting one. So there was a lawsuit which was outstanding at the year end. A decision has not yet been reached. The client has not recorded anything in the financial statements based on an assessment, their assessment, that the chances of outflow are remote. So they've not booked anything. Based on my procedures, so correspondence with the lawyer, confirmation, management discussion, etc., I have concluded that there is a possible outflow and therefore a contingent liability disclosure should be given. So this time around, the difference between the two is not a double entry. It's not a financial amount. It's a disclosure that is missing. So a misstatement is an identified problem. I know exactly what the issue is. It's not as if I haven't been able to audit this area. Now, as opposed to this, another type of issue that the auditors might face is the inability to obtain sufficient appropriate evidence. So payroll expense for the year in the statement of profit or loss is 0.7 million. And it could either be that the management has refused to give information to payroll records, or it could be that the payroll records were destroyed in the fire and that they just recently had, and there is no backup. So in this case, there's an expense in the P&L, and I have no idea whether this is correct or not. So I've not been able to obtain enough evidence to come to a conclusion regarding this. The first example where the management is refusing to give me information is a management imposed inability or scope limitation. And the second example is genuine. So it could be a management imposed limitation or genuine. So these are the two broad categories of problems that you would have listed down at the end of the audit. And we now need to see how these are going to affect the audit opinion. So that is what we're going to be looking at next. We'll start with misstatements, and I've copied the list just there once again. Now, very, very easy marks in both AA and AAA. Before we decide the opinion, we're going to ask management to correct these misstatements, right? So we took this list to the management. We're not talking about the board or the audit committee yet, the management. And we said, could you please correct these misstatements, because we've identified this and concluded on this. And suppose the management have agreed to give the disclosure. So I'm going to cross this out because this misstatement has now been sorted out. However, they have refused to amend the revenue and inventory related issues. We then went to those charged with governance. Remember, those charged with governance is a term that we use for either the audit committee if the client has one, or if not, then it could be used for the entire board of directors. So we then went to those charged with governance and we asked them to correct this. So they had like a little meeting and they have agreed to write down the inventory by 0.2 million. However, they do not think that IFRS 15 has been breached and they have refused to remove the amount from the revenue and book it as a liability. Now, for another super easy mark, we are going to get them to give us a written or management representation about their reasons for not correcting this. And once we've evaluated the impact on opinion, we are going to tell them what the opinion is. So sort of like a final warning that if you don't correct this, this is how it's going to affect the opinion. Now, if you're a AAA student, these are very easy technical and professional skills marks when the examiner asks for further actions to be taken before the audit report is signed. This is relevant to AA as well. These are not procedures. These are actions that auditors need to take just before they decide the opinion and issue the audit report. Now, we are now ready to evaluate the impact of that uncorrected misstatement on my audit opinion. So that was the revenue, which is overstated by a certain amount. I think it was 0.6 million. Can't imagine, I've just forgotten that. Anyway, so we now have to evaluate whether that uncorrected misstatement is material, or material and pervasive. Now, we are going to use certain thresholds for our exam. Remember, materiality in real life is purely judgmental. It's up to the auditors to decide materiality, and of course, they keep reviewing it throughout the audit. But in the exams, be it AA or AAA, we all need to have like similar guidelines so that the answer pretty much remains the same. So what you need to do is you need to use 5% of profit before income taxes. So profit before income taxes. We use 1% of total assets as our guideline or benchmark, and then we use 0.5% of revenue. So my uncorrected misstatement that the management has refused to amend was 0.6 million. I hope I'm right. Anyway, So we need to compare this to profit, total assets, revenue figure, whichever ones are given in the scenario, and we have to decide whether they're immaterial or material. So let's talk, just talk about the first two. If they're less than 5% of profit, etc., this would be immaterial or not material. However, if it's 5% and above, etc., it is going to be material. So that evaluation needs to be done in practical life and in the exam. Please remember there are certain areas which might not be material by amount, but could be material by nature. In your exams, the biggest example would be related party transactions. Now, the third one is where you might need a bit of time with in terms of understanding. Some items might be material plus one. This is how I normally remember it. So pervasive means they pervade the financial statements, they take over the financial statements. So they're not just material, they're like massive. As per your auditing standards, a pervasive issue could be one which is not confined to a specific account or item in the financial statements. So it could be a problem which could affect many areas of the financial statements. So for example, suppose useful lives have been increased across entire property, plant and equipment classes without justification. So not just plant and machinery, but across all classes of PPE. Now, this will reduce expense. This is going to inflate carrying value across the statement of financial position as well as profit or loss. This is pervasive because the error repeats across many asset groups and periods, and this will affect assets, accumulated depreciation, profit, and of course, key ratios. So although it's like one decision, because it's not confined to specific elements, we are going to call it pervasive. Another example could be it is confined to a particular area, but it represents a substantial portion of the financial statements. There's no percentage for the word substantial, but in your exams, both AA and AAA, it'll be very easy to pick up. So for example, you could say in my same example, if it's 0.6 million revenue that they have recognized early, and in my example, if the profit figure for this client is say 0.3 million, by booking this, by reversing this revenue, this will actually become a loss of 0.3 million. So it's literally just one double entry, but it represents a substantial portion of the financial statements. It will change the outlook of the financial statements, therefore it is pervasive. And the most interesting part is pervasive does not need to be in double entries or amounts only. A pervasive misstatement could also relate to a disclosure, which is fundamental to users' understanding of the financial statements, and that disclosure is either completely missing or it is inadequate or inaccurate. So for example, your going concern disclosures. Maybe the client is no longer a going concern. Financial statements have been made on a breakup basis, so all the numbers are correct in the P&L and SOFP, etc. But a disclosure to explain the basis of preparing financial statements has not been given. So even though all my double entries and numbers are correct, this is a disclosure which is fundamental to users' understanding of the financial statements, and therefore I am going to call it a pervasive issue. If this disclosure is not proper, then that's a pervasive issue. It could also be maybe disclosures related to accounting policies. Now, so step number one, I've identified that it's a misstatement. So I've been able to obtain evidence and I know exactly what the problem is. Step number two, I've evaluated whether it's immaterial, material, or pervasive. And I am now ready to decide my opinion. So this was nice and easy. If the issue was immaterial, the opinion I give is going to be unmodified, which means I'm not even going to refer to that 0.6 million. I'll simply say this is a nice, clean opinion. I'll simply say, in our opinion, the financial statements present fairly in all material respects or give a true and fair view. Because we are focusing on the material issues only and 0.6 was immaterial, then I'm not even going to refer to this. On the other hand, if my assessment is that this is a material issue, The opinion that we'll give is called a modified opinion, and there's a specific type called qualified except for. So we are going to state, in our opinion, if except for the effects of the matter, which we're going to describe later on, financial statements have been presented fairly. So we're basically telling the shareholders, you can rely on the rest of the information, but it's just this one double entry regarding revenue and liability, which has not been correctly recorded. Or if you think it's a pervasive matter, not you think, if in the auditor's judgment this is a pervasive matter, we will still give a modified opinion, but it's a bit more serious and therefore in red, it is called adverse. So in my example, although it was literally just one double entry, it was converting a profit into a loss. So I am going to say, in my opinion, financial statements do not give a true or fair view and or do not fairly present the position and performance of the company. So there are basically two types of modified opinion that we've covered up till now, either qualified except for or adverse. So remember, an adverse opinion is only given when there is a misstatement that is material plus pervasive. So we are officially done with deciding the opinion based on uncorrected misstatements. So this is a nice summary with quite a big font. The uncorrected misstatements could be in amounts or disclosures, and I've summarized what opinion is going to be given. Remember, in both exams, AA and AAA, you will have to build up to this. So my sequence of slides is basically the sequence of your marks and your answer technique. It's a misstatement, evaluate its materiality, then decide the opinion. Moving on to the second type of issue that we spoke about. So this is the second category. We're not basically saying that we know what the problem is. We were not able to obtain sufficient appropriate evidence regarding this. So remember, there were two types or two examples. It was either a genuine inability or it was management imposed. If it's management imposed, which basically means the client has the information or evidence, but they're not giving it to me, then in that case, I'm going to follow like a similar sort of pattern. I'm going to ask management to give me that evidence and therefore remove the limitation. If they don't do that, I'm going to take this up with those charged with governance and try and attempt alternative procedures. So if there's any other means of gathering evidence, you can do that. If this is still unresolved, similar to what we did earlier, we are going to tell them the effect on the auditor's opinion. We're going to ask them to give us a written representation regarding their scope limitation. So we basically, we know it's their responsibility for providing access to information, and they'll have to give us a representation around that. And super important, I'm now going to be very concerned about their integrity because they're hiding information from me, and I can consider withdrawing from the engagement if it is necessary and allowed by local laws. So lots of marks here when you identify that the inability was not genuine. They have the evidence, but I've just not been able to obtain it because they're not sharing it with me. Quite similar to what we've already done, so nice and easy. Suppose my payroll expense was XYZ, maybe 1 million. I'm going to evaluate whether it is immaterial, material, or pervasive. There's absolutely no difference there. The difference is going to be in the way we word our opinion for a pervasive inability. So similar to what we've just done earlier, if it's an immaterial inability or that amount is immaterial, we're going to give an unmodified opinion, simply say, in our opinion, financial statements give a true and fair view. On the other hand, if it's material, maybe like 10% of the profit figure, we'll say, except for the effects of this particular inability that we're going to describe later in the report, financial statements give a true and fair view. So we're telling the shareholders that it's just this payroll expense that we haven't been able to conclude on. you can rely on the rest of the information. However, if it's a pervasive matter, then the opinion that we give is called a disclaimer of opinion. So we are basically going to say that we do not express an opinion on the financial statements and we have not been able to obtain sufficient appropriate evidence. So we are not giving an opinion and we've not been able to obtain this evidence. So if I sum this up for you, your unresolved inability could lead to an unmodified opinion if it's immaterial, qualified except for if it's material, and a disclaimer of opinion if it's material and pervasive. Just summing this up for you, I won't take too much time over here. In reality, there are really just two types of opinion. Opinion will either be unmodified or it would be modified. For modified opinions, we have three types. A qualified except for is given when there is a misstatement which is material or when there's an inability or scope limitation which is material. An adverse opinion is given when there is a misstatement which is material plus pervasive. And a disclaimer of opinion is given when there's an inability to obtain sufficient appropriate evidence which is material and pervasive. So this is what we were covering since we started this video. Now, what happens to your auditor's report when an opinion is modified? We are going to cover this right over here. So when your opinion is modified, this is going to affect your report in a number of ways. Of course, the wording will change like we just discussed. So remember, a modified opinion could either be qualified, adverse, or disclaimer. But in addition to that, the headings of the opinion paragraph will change to reflect the type of opinion given. So it would say a qualified opinion, adverse opinion, or a disclaimer of opinion. Underneath the opinion paragraph, we'll talk about this in just a few minutes. We have something called a basis for opinion paragraph, and the heading for this paragraph changes. So we will now call it basis for qualified, adverse, or disclaimer. And this is where we explain the details. So remember, in my opinion wording, we just kept on saying, except for whatever is explained later, everything else is okay, right? In my opinion. But the basis for opinion paragraph gives you that detail. It will explain that it is revenue, which is, have forgotten, haven't I? 0.6 million, and it is overstated because based on IFRS 15, it has been recognized too early. So the details are given in the basis for opinion paragraph, and you can actually tell this from the way it is worded. So you get additional marks for talking about the change in headings for both opinion and basis for opinion, along with the content of basis for opinion paragraph. Okay, so we've covered the opinion part, which is obviously very important because this is why you were hired to begin with. We're now going to move on to super important concepts, which are additional paragraphs in the audit report, which will only be added if they are required based on the individual client. So you won't always see them. You will have to evaluate if these paragraphs are needed. We are going to be looking at each of these one by one. The ability to decide whether this paragraph should be added and how it's going to be added is a very important skill for both AA and AAA. So you'll have to be very careful about this. Starting off with the first one, this is your material uncertainty relating to going concern. I'll give you a bit of background because that's required here. Let's just revise what you've covered in the going concern review. If you remember, when we were carrying out the going concern review, there could be two types of problems that the client might have faced. So the original situation that there's no going concern issue is not a problem, right? So financial statements are prepared on a going concern basis. There's no uncertainty, nothing needs to be done. However, sometimes there could be an uncertainty relating to the financial statements, which basically means that the client might face liquidity problems in the next 12 months. And we know that this uncertainty needs to be reflected in the financial statements by adding a disclosure. So based on our reporting knowledge and IFRS 18, when there's an uncertainty from the management's perspective regarding going concern, then a disclosure needs to be given. There are no double entries required. On the other hand, if the going concern assumption is incorrect, which basically means the company is not a going concern, they are going to shut down in the next 12 months, either because it's a plan or because they have no alternative but to do so. In this case, your financial statements are made on an alternate basis, for example, breakup basis. This basically means lots of double entries in your financial statements, plus a disclosure needs to be given to explain the basis of the financial statements. So don't just use the word disclosure. You'll have to tell me exactly what disclosure you're talking about. Is it an uncertainty disclosure or is it a breakup basis disclosure? So this is something you would have covered at going concern. Now let's come back to my audit report. And this paragraph is going to be linked to my content in green. There was an uncertainty. The client has given a disclosure and we have confirmed that this disclosure is absolutely perfect. So remember my words. To highlight this perfect, correctly given disclosure, we are going to add an additional paragraph or section in the auditor's report called material uncertainty relating to going concern. So this is included as a separate section in the auditor's report when there's a material uncertainty and the disclosures are included in the financial statements and they're adequate. So basically, this is added in my audit report to highlight a correctly given uncertainty disclosure. There is no other reason in the world for this paragraph to be added. So remember this is an easy one to figure out. So when we've evaluated that this section needs to be added in my audit report. So by the way, just think of it like this. My financial statements are going to be like 500 pages long. That's exaggeration, but let's just assume it is. And shareholders are not going to read those 500 pages because they might not be accountants. And frankly, even if they are, they maybe don't want to. So through my audit report, I'm basically telling the shareholders to go have a look at this one specific disclosure, which I think is very important. So I'm using this section to highlight that correctly given disclosure. So once I've decided to include this, it's going to be added separately. It needs to refer to the disclosure number in the financial statements. It needs to explain that we're not modifying our opinion because there's no problem with that disclosure. And we need to clarify that we're not guaranteeing that the company will continue as a going concern. We're just pretty much highlighting this disclosure for you. And normally, this is going to be placed underneath the basis for opinion paragraph. So when we go back to my original modified report, the placement will be quite clear. So that was my first category of additional paragraphs that might be needed. My second example is an emphasis of matter paragraph. Other than the material uncertainty regarding going concern one, if there is any other correctly given disclosure or matter which is fundamental to users' understanding and it's correctly given in the financial statements, you can highlight that by using an emphasis of matter paragraph. So the idea is exactly the same. Out of the 500 pages of financial statements, I want the shareholders to particularly go and look at this specific additional disclosure. Not additional disclosure of the financial statements, but from my perspective as an auditor. So it is used to again highlight a correctly presented or disclosed matter in the financial statements. And also remember that matter needs to be important enough for it to be mentioned in an emphasis of matter paragraph. We need to explain what the disclosure number is. The title should be an emphasis of matter paragraph. You can actually write the name of that matter. And you need to explain that because this is correctly given, I'm not modifying my opinion. So adding these extra paragraphs does not mean there's a problem. I'm just highlighting a correctly given issue, mainly because there's uncertainty involved, and I think it's important for users' understanding of the financial statements. I've put quite a few examples here. You can read them on your own, but I'll just talk about a few common ones. To know my going concern breakup basis disclosure, the red part, you can actually highlight that through an emphasis of matter paragraph. Remember, uncertainty was in green. It's less serious, so it has its own section. The other one, the breakup basis one, and it's all been done correctly. So they've made the financial statements on the breakup basis. The disclosure is there. It is accurate. It is complete. And to highlight that, I can add an emphasis of matter paragraph. It could also be used to highlight a correctly given contingent liability disclosure. It could also be added to highlight a correctly given a non-adjusting event disclosure. So remember, the key is it's all correctly given in the financial statements, but we're just highlighting it by adding an extra paragraph in my auditor's report. Now, the third one, I wouldn't want you to worry too much about. It's not very frequently tested in either AA or AAA, but of course we have to cover it. The idea of an other matter paragraph, which is my third example, and the last one for the optional paragraphs is another matter paragraph. Now, this is included when auditors, I'm going to use this word on purpose, when auditors want to whine about something relating to their audit or their auditor's responsibilities and tell the shareholders. So this is not meant to be offensive at all, by the way. Me saying this is me trying to ensure that you remember these odd words in your exam. So this is not about what's in the financial statements. Remember that. It's about something relating to the audit, my responsibilities or my report, and I want to communicate this to the shareholders. Now, again, I've put a few examples here. You can go through them in your own time, but examples could include just telling them that this is the first time I am auditing this client. The previous year's financial statements were audited by another firm. Another example could be that the client has prepared financial statements under a number of reporting frameworks. So they've done it according to local law and IFRS. And I can use this paragraph to reference to a separate report if it has been issued on the other set of financial statements. So certain examples that you can go through, these are all from your auditing standards. So we've now officially covered the 3 additional paragraphs. Remember, we'd already covered opinion and basis for opinion. We've covered now where the placement of the MURGC, if it's required, it'll be under basis for opinion. An emphasis of matter paragraph can be placed before or after CAM. We haven't done CAM yet. We're just going to do that. But this depends on the auditor's judgment. It could, the other matter paragraph will normally be under the key audit matter paragraph. Moving on to the next paragraph that you will always see in the audit of listed companies or other public interest companies is something called Key Audit Matter. Now, a few things to keep in mind. They are included in the auditor's reports of listed companies. This is mandatory, but it can be included in other audit reports if the firm chooses to do so or if it's required by local law. It is there as a separate section, and if there is no key audit matter, a statement to say this should be included. Now, I'm just going to backtrack a bit. This is also an earlier topic. You would have read this at some stage of your syllabus that there's certain matters that need to be communicated to those charged with governance. I've summed them up on this table, so you can pause the video and go through them. But for example, we must communicate to those charged with governance any significant risks and our audit plan regarding addressing these. Any issues regarding my independence, any difficulties that we faced during the audit, my views regarding accounting policies, accounting statement estimates and financial statement disclosures, etc. Any material adjustments, even if they were corrected. So remember, the uncorrected ones come to them anyway, but even if they were corrected, because it was a material double entry, I would want to communicate this to them. So up till about 6-7 years ago, there was no concept of key audit matters. It was just communicate to those charged with governance. But then the standard setting board said, hang on, it is really the shareholders who appoint the auditors. So some of these matters should also be communicated to the shareholders of listed companies through their auditor's report. So rule number 1, the matters are determined from or selected from matters that were communicated to those charged with governance. Then how do I do that? So what is my criteria? That was a big list. Suppose I ended up reporting 35 matters to them. Which of these should be reported to shareholders as well? You've been given some guidelines around this. So they required a lot of auditor attention, and they were, again, there's more clarity around this. They were very risky. They required a lot of judgment, or they were literally just major double entries or transactions or events during the year. So very risky, required a lot of judgment, or something major that happened during the year. So I, as an auditor, had to spend a lot of time on this and give it a lot of attention, which means senior people, etc. Because of these 3 factors, it could be just one of them. And therefore, I think this is of the most significance in the audit. So as an auditor, I'll have to apply a lot of judgment in identifying out of the 35 matters, which of the ones of these 35 matters are the most significant, and they required a significant amount of judgment, and again use ABC as the criteria to filter that out. So suppose out of the 35, I've come up with 2. I could maybe talk about revenue recognition, and I could talk about maybe impairment. So this is not relevant for AA, but I'm sure you know what impairment of assets is. So when the value goes down for one reason or the other. So I'm just taking examples. I'm not going to go into the detail. So these were significant matters. I haven't modified my opinion because of this, by the way. So everything is been sorted. My opinion regarding these matters is unmodified, but they were significant matters for me. Once I've identified revenue and impairment as a key audit matter, for each of the matter, I am going to explain why it was a key audit matter. So is it because of risk? Is it because of judgment? Or is it because this was something major that happened during the year? How did the auditor address this? So a brief overview of the procedures that were performed. And if there's a disclosure, then a reference to any related disclosure in the financial statements. Another thing that you need to remember is when we put this section in the auditor's report, the paragraph should start with an introduction which explains exactly what key audit matters are. So in my audit report of listed companies, you are going to have an introductory paragraph in CAM which explains exactly what key audit matters are. And then for each of the key audit matter described, you are going to explain the why and the how. So why was this determined to be a key audit matter? I've given you the 3 guidelines and a summary of the audit work that was done on this. So if I come back to my original screen when we started this video, you will see key audit matters do not modify my audit report. They're a requirement. They should be there every single time. So you should be able to understand and explain what key audit matters are, understand how they are determined and how they are communicated. So when you go back to my slides, as you're reviewing this, how do you pick them up? By selecting them from matters communicated to those charged with governance, and of course the criteria. And how do you communicate them? We have an introductory paragraph and then why they're a CAM and how they were addressed in audit. We're now going to move on to the detailed contents of the auditor's report. The details in particular are more important for AAA because you are going to be asked to critically evaluate and extract of an audit report. By the way, AA students still need to watch the rest of the video because it's still relevant to you, but the details of each section are highly examined in AAA as compared to AA. So I've just put it in a way that it's easy for you to understand and review. The sequence is exactly the same as my slides earlier, but you can pause at each slide or screen and read this in detail. I'll just give you a quick overview. The audit report starts off with the title, which should explain that this is an independent auditor's report. So you're basically, I don't know why I'm crossing that out. You're basically differentiating this from an internal auditor's report. The addressee is normally the shareholders. Then you have the opinion section, and it's not just the opinion that you give straight away. Opinion comes later on. We start with the name of the client. We explain or write the full names of all elements of financial statements. We also give a reference to the notes to the financial statements, including significant accounting policies. We mention the year end, we mention the reporting framework, and then we give an opinion. This is a nice, clean opinion in an unmodified auditor's report. On the other hand, when the opinion is modified, I've put this again here, so I'm bringing everything that we covered in the video together. So you will see how various issues impact this report in the third column throughout the rest of the video. We then have the basis for opinion paragraph in a nice clean report, and in both, to be honest. We always refer to the fact that we have used international standards on auditing. You need to refer, because we're doing the international version of the AAA exam, and there's no version for AA, but we refer to the independence criteria, which is ISB's Code of Ethics. We'll say that our responsibilities are described in another section. And then finally, because it's an unmodified report, we will mention that we have been able to obtain sufficient appropriate evidence. Remember, when opinion is modified, the heading changes and we explain the issue that's there. And in a disclaimer of opinion, we won't write that we've been able to obtain sufficient evidence. Next, if you've added a material uncertainty paragraph, it goes underneath basis for opinion. I've recapped everything that we have studied. We refer to the note number, etc. For listed companies, we then have the key audit matter paragraph. We start off by explaining what key audit matters are, and then description of key audit matter, why it is a key audit matter, and how I address this in my audit. An important thing, it's not really been tested, but something for you to keep in mind, when we are issuing a disclaimer of opinion, then we will not be adding a key audit matter. Remember, a disclaimer was when there was an inability which was pervasive. If an EOMP is going to be placed, it could be either before or after CAM, and then we have an other matter paragraph. It's all mentioned over here. Now, this is an important one. This is something that some of you might struggle with. Other information, this section is always there in the auditor's report. So let's just recap this. I'll scribble on one side. So I'm sure you're comfortable with the word annual report. Remember, my annual report has the financial statements. It has the external auditor's report that we are studying, and then it has a lot of other information. Now, this could include, for example, the chairman's statement. It could include a sustainability report. As auditors, you would have covered this at the review stage. As auditors, we are required to read this other information and see if there is any inconsistency with the financial statements or with auditors' own understanding of the business, or if there's a material misstatement of fact. So the idea is, in the sustainability report, the client has said, we spent 7 million on making our property, plant and equipment environmentally friendly. I've audited property, plant and equipment, and I know that's not true. They've only spent like 1 million. So I have been able to identify an inconsistency between the other information and the financial statements. I'm going to ask management to stop lying and correct this. But if they don't do it, I'll mention it in the other information paragraph. On the other hand, if there is no inconsistency, this section will still be there. It's not one of the optional paragraphs that we studied. Those are only 3. So in this section, in a nice clean report where there was no inconsistency, I will explain what is included in the other information. I will explain it is management's responsibility to prepare this. I do not express an opinion on this. It is my responsibility to read it and look for inconsistencies. And in a nice clean report, I would say I have nothing to report. Or if there was an unresolved inconsistency, I will mention it there. So I'll go on to explain that, by the way, the sustainability reports says XYZ, and this is what the truth is. Remember, we only give an opinion on the financial statements. We do not give an opinion on other information. After this, you can read this on your own. We have responsibilities of management and those charged with governance. Please remember the placement. We have auditors' responsibilities. If, according to local law, you have additional reporting responsibilities, they will be mentioned over here. For listed companies audits, we need to include the engagement partner's name. We then have signatures of the partner, the firm, or both. We have auditor's address so that shareholders know exactly who they can contact if they have any follow-up questions. And we finally have the date of the audit report. Remember, this is a very important date when we were doing our subsequent event review. So this is basically something that you have studied before, but it comes right towards the end. So just to recap, this entire video covers almost all the knowledge that you need to attempt any question in the AA or AAA exam. This is knowledge that will normally be applied to the scenarios given in the exam.